Okay, this episode is exactly why we created this podcast, why we created this show. We can speak to people that have achieved some amazing things in the property world. This guy, Richard Morgan, multi-million dollar property portfolio, super big swinging everything. And he's so humble. He doesn't want to talk about his amazing sport car collection. He doesn't want to talk about all the crazy things that he's got from property. He just wants to talk about the numbers, but not in a way that's boring. So I asked some really interesting questions because I am engaged throughout this entire conversation. And I think everybody, no matter what stage of your portfolio, is going to get stuff out of this. So this was more aimed, it's called Supercharge Your Portfolio. This was more aimed at the people that are further along their journey and how they can accelerate beyond there. But it's way more than that. We start learning about his portfolio and also looking at some of the structural changes that are happening in the broking space that are going to open up borrowing capacities and serviceabilities for people, how we can lend more, how we should think about structuring our lending, and how we can become a better property investor. What I love, my favorite part of this conversation is one, the context of just looking at the property as a return on investment. I have an allocation of capital and I have an allocation of borrowing capacity, and my goal as a property investor is to allocate that in the best way that's going to get me the best rate of return. Hey everyone, my name's Joe Tucker from Oz Property Investors, and together with Jeff Miles, we created this community to help everyday Aussies build sustainable property portfolios through learning and growing and going out there and making it happen for yourself. And each week we interview top property experts so we can all learn and grow our property portfolios together. Specifically, we have Richard Morgan here. He is a mortgage broker that is unreal. He goes deep into the world of real estate, the world of property, the world of lending. But really, the key takeaway that I'm taking away from this conversation is how he thinks about investing from an ROI perspective. He's very analytically focused and doesn't care about fluff. It is literally just the numbers and how it translates to value. So I think there's a whole heap in here for everyone. Let's dive in.
Welcome to Oz Property Investors. We bring the big names and we have the big fun. And we've got Richard Morgan tonight. How you going, Richard? What's happening?
Yeah, really good, Jeff. Thanks for having me on the show.
Welcome, mate.
Absolutely welcome. Thanks for coming on. No,
I think it feels like I've got. Sorry, it feels like I've got really big shoes and a really big shirt to fill after seeing that banner. So hopefully I can live up to the expectations.
Yeah, the posters are getting more and more unruly. Which I'm happy for. Very happy that these posters are getting more and more ridiculous. I will take it. But we got you there, mate. You're driving a Maserati. Maybe that's a bit of a spoiler alert, as the man himself doesn't boast too much about it. You're not a boaster, that's for sure. But you've definitely achieved some awesome stuff in the property investing world and in business itself, right? You're a broker. But it also, I mean, you've been investing for what, 20 years? Is that what it was?
Nearly 2 decades.
It's a long time. I kind of feel old when I start talking about things in that context. But you know, I feel like I'm still young. I'm 42 this year. So yeah, my wife and I have been on this journey for 24 years now. So
Wow.
She started a little earlier than I did, and yeah, it's been a wild ride, but we've still got a long way to go.
Before we introduce you and what we're going to be talking about tonight, as a bit of a bonus and a bit of a curveball, how is it sort of having that partner to support, or not to support, to even encourage, like get you on that journey? Like, has it been sort of like kicking you in the butt to make sure you're kicking your investment goals as well? Like, how's it been having that?
Really, I think for us, it's been a thing that's been able to get us to where we are. The fact that the two of us are very similar in terms of what we're into. We both met many years ago over a mutual love of cars, of all things, and you know, that sort of sparked the initial conversation that we had, and eventually found out that, you know, she's really passionate about investing in property. I'm really passionate about investing in property, and you know, we both came from backgrounds where, you know, we didn't have a lot of money growing up, and you know, really had that drive and ambition to do stuff. And for us, both being aligned in the property world and that sort of drive to succeed, It's been, I guess, a great alignment, not just, in terms of the romance and all that sort of stuff, but being able to work together and do our own things together has been really, really good for us.
Super interesting. And what is it about cars like that you love so much? Like nice, ridiculous cars.
You know what? I don't know what it is. And when you try and explain what it's like to be into cars to a non-car person, they kind of look at you like you've got something wrong with you. And maybe I do, but
Three heads, two heads.
yeah, I don't know what it is. But I mean, for me, it's the experience of driving a nice car. I've always liked driving cars. And I mean, now we've got cars that are a little bit more flashy than, what we've become accustomed to. And I drive around feeling like I'd want to be invisible. I'd rather be the guy that can take the car out, Sunday morning when nobody's around, up the old Pacific Highway and go and have some fun by myself, not parading around Double Bay at coffee shops and whatnot. So yeah, I love the experience of driving cars, and Mel, my wife, she's come from that same vein. So yeah, we're continuing that journey, and now we're back in the cars. Mel had a bit of a break for a while there, but yeah, we're back, and I suppose in a slightly different capacity, the cars are a little bit better than they were, 24 years ago.
Yeah. Well, and also it doesn't start with a beautiful Maserati. It doesn't. That is not even the end, I guess, for you guys. But like, take us. Well, actually, Jeff, you want to introduce the show? What are we going to talk about here? What are we doing? And then we can kind of jump on in.
Before you car enthusiasts sort of take it away, and for me, I'll say why I'm not a car person either, but for me, the excitement of just going fast, and that's why I don't know if I'd ever own like one of those. I might go and rent one, but for me, I don't feel I could use it to its full capacity. But anyway, tonight we're here to talk property lending and getting into your lending overdrive, which if you pick that up, then shifting gears, so many puns in this, and accelerating lots of stuff. So we're here tonight with Richard Morgan. I'll introduce him in a minute. We're going to talk about what the macro changes are coming down the pipe, which are potentially going to be very sort of positive for borrowing capacity, doing that sort of stuff. We'll sort of whet the appetite with that. But importantly as well, I think that given Richard's been investing with his wife as well for close to and beyond 2 decades, I think there's some knowledge and there's some wisdom there about when you're sort of at a crossroads of, am I putting the cue in the rack, or am I going to go hard? Am I going to shift into fifth gear and go faster on the property investing journey? Those are sort of things, including things such as doing developments or sort of structures, or even sort of maybe selling 1 or 2 properties down. So that sort of knowledge and wisdom sort of soaked up. That's what we're going to be talking to tonight, because it is harder out there these days with interest rates a little bit higher than what they were a couple of years ago. And they're sort of at average, but yeah, a lot of people wouldn't have seen these sort of 5-6% rates. So that's what we're going to talk about tonight, Joe.
Let's crack on in then.
So who have we got in front of us today? So as I've sort of alluded to, Richard has been investing for almost 2 decades and has had the success that's enabled him to leave the corporate career and start Freedom Funding, which is a broker, a broking business. And you sort of have that results runs on the board, so to speak, with investing, renovating, developing, but you've also got the ability to navigate the finance in your own sort of personal investing plus others. So you're building, I think you said you've got 10 plus sort of staff at the moment. So you're building that out starting to build it out quite quickly. So good on you for doing that. So, but apart from cars, Richard, what else is a big passion of yours before we get into the meat and potatoes?
Yeah, so I mean, really, for us, it's all about property. We're property mad, and between having 2 young kids, 2 daughters, all the sort of stuff that you've got to do for them in terms of help them in the world this early stage. Between that and property, there's a little bit of time for the cars, but there's really not much time for much else. And to be honest, I don't think I'd have it any other way. I really am fortunate that I really enjoy what I do, and it's it was always a dream of mine to be able to exit the rat race, quit the corporate world, and start my own business in property. And finance broking was the natural fit for me in terms of my skill set, my capability, and being fortunate enough. We're not quite at 10 people, but we've got a team of 7 now, and things are looking quite good in that space.
Unreal. So take us back to your first property purchase, because I think it sounds like, because we had Mel Morgan on. She did an amazing show. If anyone wants to listen to that, I think it's on YouTube. We covered up a whole heap of stuff. But how did your property journey start? What did that kind of look like?
Yeah, it was a long time ago. It was 2006, and I bought my first property down in Melbourne, Victoria, Richmond. It's a 2-bed apartment. It's about $220,000. I remember, scouring the entire city of Melbourne, trying to understand, what can I buy and all that sort of stuff. Eventually landed there, a little apartment that I could add a little bit of value to. I used a mortgage broker back then as well. That property I still have in the portfolio all these years later. And it is worth a little bit more than 220K these days.
Was it like a small unit in like a small complex, or was it a large, big development thing?
Yeah, so really following those fundamentals of trying to buy quality in quality locations, that's been what's performed well for us. And with apartments in particular, making sure that it meets a selected criteria around being at least 50 square meters internally, so it's got good sort of market attractiveness. It's actually a 2-bedroom layout, so it's good from a yield perspective. Required a cosmetic reno, but it's in a small walk-up block. There's only 8 in the complex. It's on a good street, and there's probably some strategic value in the land there. Probably not right now, but probably down the track at some point. Things sort of unlock from a zoning perspective, and so.
There you go.
Nice. Fun little intro. So you didn't get burned. So you did it sounds like you did a lot of research and education before you went diving headfirst into property investment. You didn't get caught by the house and land spruikers, the off the plan apartments and that kind of stuff.
Yeah, exactly. I mean, I deferred my first property purchase for a while, and it's one of those sort of things you reflect back and go, "Oh, geez, I should have got in a couple of years earlier." But the car thing, it actually got to me, and we're importing cars from Japan to resell here locally, and so I had a bit of capital tied up in that, and eventually ended up buying the car I really wanted at the time, which is Nissan GTR, if you want to know the details, and I held onto it for too long. It cost me too much money, and I sold that when I moved down to Melbourne with work at the time. That was basically my deposit there, plus the Victorian First Home Owners Grant, which I think was like $7,000 at the time, which I got audited on, by the way, just add a little bit of stress to that process.
How do they audit you? They ask you to sort of people come around to your house late at night and are you living here? Like, should knock on your window.
Yeah.
Are you Richard? No, I shouldn't.
Well, I think it looked funny because for Vic State Revenue Office, they would have seen it in terms of me being a New South Wales resident, moved down to Victoria, and then moved almost straight back up from Victoria to New South Wales. It was just a coincidence. It was basically 6 months and 1 week that I lived in that property, and it wasn't planned like that. I was supposed to be down in Melbourne for a little bit longer, but the business I was working for was a great business, and they moved me down to Victoria, and then they moved me back up when another opportunity came back up in Sydney. So it was just luck that it worked out that well, which is just as well, because if they had audited me, then I failed that, then that $7,000, I didn't have that $7,000 back then.
Jeez, you're really you're Icarus flying close to the sun. But I want to know, this is only probably about 2008, roughly, was it 2007, 2008, around that time?
2006, yeah.
And how much did you pay for? Was it an apartment you picked up from memory?
2-bedroom apartment, yeah, 220K. I don't know what the house price median was around there. I guess it was probably. I do remember, because I looked at every property in Victoria, it feels like. There were a lot of houses I looked at in the sort of southeast corridor, Rowville, Mulgrave, that sort of thing, along the freeway. I think they were about 250 to 300K for a 4-bedroom house. So things were pretty cheap back then.
That's so much better. A 4-bedroom house. You bought a 2-bedroom unit for 220, or you could have bought a 4-bedroom house for 60 grand more.
Correct. Yep. So that would have been a much better purchase, and one of those things that you learn in hindsight, right?
But also, you couldn't afford it, right? You couldn't afford it, that extra 60 grand, because that's what, like another 180,000, maybe not, maybe 100 and odd thousand now.
Correct. I was all in terms of that purchase for me at the time.
And I just looked it up because this is crazy. In 2006-7, Melbourne, there's a report released today, Melbourne house price grew faster than any other capital city in Australia in 2007, jumping by almost 100,000 to 463,000. So in 2007, Melbourne property prices did 25%. So that's insane. Like it's sort of, sorry, yeah.
Right place, right time, right? I mean, sometimes you get lucky with this stuff. I knew it was going to be. I knew there was going to be growth there because I could see on the ground how many people were going to the opens and all that sort of stuff. And I thought, oh, geez, I need to really commit to making this happen. And you see it all the time when the marketplace gets busy. It's difficult to buy property, and a lot of people just sort of put their hands up and give up. I was lucky to be able to buy what I bought for that price at the time, and it served me well. But asset selection again could have been better, but it's one of those learnings you take along the journey.
Yeah, love it. Well, one of the other areas that you're now, because I'd love to go through your whole portfolio, but I feel like we'd be here all night, and I know you have a lot of value to share from a broking perspective, but Jeff actually coined it pretty well. He's talking about the things that we don't have control of, but we should be aware of, because there may be some opportunity there. Can you talk about some of the more macro changes that you're seeing out there in the lending environment that a property investor, because right now, right, interest rates have gone up 13, 14 times in a row. There's a whole heap of negativity out there. I'm trying to buy right now on the ground, and it's a bloody nightmare. Like, there is a lot of competition in pockets, and then there are other pockets that are just absolutely dead. So what are some of those macro changes that you're kind of seeing, and are they positive for property investment or negative? Like, where do they fit on that spectrum?
Yeah, cool. I guess from my point of view, the macro scene is that we've got a market that's growing. But those rate rises have completely hammered borrowing capacity. So borrowing capacity is down some 40% on where it was prior to that rate increase cycle. So most common conversation I have day to day is that people can't borrow enough. And regardless of whether they're investors or owner occupiers, that appetite to borrow more is there. And I think there's also that appetite that is there from the banks themselves, seeing a lot of sort of fringe improvements around policy, seeing things like 1-year bonus policy coming in instead of needing 2 years of bonus policy, seeing better valuation platform tweaks coming through where they'll accept contract of sale instead of going through full vals, and all these little tiny things that are coming around the edges. That make it, from a banking perspective and a loan approval perspective, a little bit easier to do business, and are potentially setting the scene for when we get the right market conditions come together around things changing in the future. Credit availability and the ability to put together credit should come a lot easier. And I think that has a propensity to fuel the market. So there are a couple of macro level things that are on the horizon that, to your point, Joe, you can't really change them, and they're either going to happen or they're not going to happen, or they'll happen at some point, but it's undetermined as to when that is. Do you want me to jump through the detail on that?
Yeah, let's go through them. What are the three things that I mentioned? What's the first one you think is going to have the most impact, the least impact, or should we go least impact to most? Let's go least to most, because I want to leave the best thing to last. What is of those three things we mentioned? I think I know the answer to this one, but yeah, what's the thing that you feel of the three we talked about that will have some impact, but maybe not so much?
Yeah, cool. So I think the first one is for all but confirmed, right? I mean, this is after Albert decided that he's going to change it all up. He might change it all up again, I'm not sure. But the stage 3 tax cuts, 1st of July this year, they should be coming through as legislated. They should be in a position where what essentially will happen is most people will have more net income as a result of the reduction in the tax rates. And therefore, you can have a better position with a net income to service debt. So we sort of run some different scenarios, and I mean, sort of average out around 5% more in terms of borrowing capacity with the stage 3 tax cuts coming through.
That's still pretty powerful though. You think about it, if your borrowing capacity was $1 million, which isn't everybody's, like, but and then you added 5%, that's 50K. That is the difference between an asset that sort of is just on is. So I just imagine though that happens across the market. Like, what does that? That sort of then puts a bit of a rocket under. I mean, a lot of people can then spend sort of 5% extra on those sort of even affordable areas, like 600K property. 5% of that is 6 times 5 is 30K. Which does that then? Yeah, it's interesting. And
correct.
Yeah, what are your thoughts on that, Joe?
Correct.
Do you think people getting excited about that?
I was just excited about your quick maths. Very well done. Very well done indeed. So stage 3, what does that mean? Is there more stages to come? Were there more stages previously? What does stage 3 mean?
Yes. So that is based on the revised stage 3 tax cuts.
What was it before? Do you know the numbers? What they would have been before?
I don't know what the old basically with the stage 3 tax cuts prior, it was higher incomes would get more relief, and now they've sort of spread it down, so lower income earners get more relief. I'm not sure what it used to look like in terms of the sort of benefit around borrowing capacity, but look, I think tax reform is a big thing, and we could probably talk about that quite a bit. Not that anyone is really interested in tax reform, but I think that there is going to be more tax reform down the track. I think it's very dangerous heading into 2025 when there's an election, and we've got a Labor government in place who have got a track record of going after soft targets from a tax reform perspective. So it'll be interesting to see if they try to do what they did many years ago, when they were going after negative gearing, they were going after franking credits, they were going after a whole bunch of different things, and eventually I think they went too far with that, and they lost themselves an unlosable election. So I don't trust politicians to spend our money the way that they should be spending it. I think if it was private enterprise, then they'd be out of a job with the way that they spend the money. So hopefully there's not a tremendous amount of tax reform, but I mean this stage 3 tax cut is going to be something that will be good for everybody. It will be inflationary. That's the reality of it. So it's not going to help the RBA with doing what they're doing and trying to keep interest rates down, because people are going to have more money to spend at the end of the day. But it is at least a positive around the tax reform piece.
There you go. And what's the next thing that potentially could really move the dial? I think I know what the next biggest one is, but
everyone is talking about interest rates, right? So it's going to happen at some stage. I know we were talking about it last year, and it was going to happen last year. We're talking about it this year. It's going to happen this year. Potentially,
I'd be surprised.
Potentially, it won't. Yeah, look.
I'm like the more just you look at some of those statements that the RBA's put out and even sort of you look at the RBA or the ASX cash rate tracker, it really sort of starts to, like, even for the May meeting, there's almost a 0% like it's 10% chance potentially the rates will get cut in May, and there's only then another 5 meetings this year. So you just think unless they can really, and then you've got the tax cuts coming in, so. How does that then sort of feed inflation? Sort of ticks up a little bit, and they say, "Well, rate cuts are probably off the table for 2024, maybe."
Yeah, correct. And I mean, this is where you've got one policy on one side, and you've got another policy on the other side that they completely contradict each other. So, it's logical to you or me. Unfortunately, we're not running the country, or fortunately, because I wouldn't want the job. But it doesn't make a lot of sense logically when you look at it that way. So. I do feel like inflation is going to have a longer kick than a lot of people are predicting. It feels like 2025 will be the year. I mean, we'll sort of expect that to happen, and then hope that it happens sooner, I suppose.
And how are you thinking about interest rates for your own portfolio and investing? Like, where do you put this, and how do you frame it and think about it when you see it go up or go down or stagnant or where it's at now? Like, how do you think about this?
I guess for me, it's just noise from a personal investment perspective. So everything is cyclical, right? So rates will go up, rates will go down. You'll see over time yields will go up and yields will go down as well. Almost sort of relativities with all the different metrics in the market. I think at the crux of it, I'm not concerned. Well, I mean, financially, we're in a good position, right? I mean, it affects how much these cars that we've got are costing us, right? It's not a big deal. The cost of capital, for us is, our game now is return on capital, rather than, how much the interest rates are. And serviceability is a piece of that, but it's not something that is going to worry me around doing one thing or another. What it does mean, I suppose, is that we will be more vigilant around looking at how we invest our money. And we won't go after doing a development project where we're going to make 20% if we can get a reasonable rate of return just sitting money in an offset account, and there's being zero risk there. It means we need to make sure that we sort of optimize and find those more profitable projects that we can invest in from a development perspective.
Can you talk to that concept just a little bit, the risk-free return rate, and how you think about that? That's a great.
Yeah.
Is that also the same thing as IRR, internal rate of return? Would you say that's a similar concept? Or anyway, let's keep it risk-free rate.
Yeah. So I guess at a principal level, if you've got you've got capital to invest, it's sitting there in your offset account against your owner occupier. You can take that money out, and that will cost you 6%, for argument's sake, in terms of that cost of capital based on the interest rate of the owner occ. Now, in order to say you're at the highest tax bracket, let's just call it 50%. So you need to earn a lot more than 6% on your money in order to break even on that, because that is a 6% net return in terms of that interest cost is post-tax. So you need to earn 9% or more in order to then break even on what you could be making in your offset account.
Because we actually had a post about that the other day, and how would you? And somebody's like, "Oh, you just leave it in your offset." I'm like, "Well, I mean that's all good and well, and sort of reduce that. How would you have felt about that similar sort of scenario if you were sort of one or two properties in? Would you have felt the same, or would you have said, "Okay, now I want to build the base of the portfolio, regardless of I know I could have that probably around 9% return"? How do you feel? Would you feel differently earlier in the piece?
No, it's a 6% return. You're getting the return on what your interest rate is.
Yeah, but then you've also got, but it's tax free though. So
you'd have to beat that to get 9%. You'd have to be at 9% to beat any other return.
That's what I meant.
Yeah, yeah, it's a really good question, and so for me as an investor personally, it's very different to what the way that I would look at things 20 years ago or 15 years ago, because I had no money and I couldn't do anything. So now I have some money and I can make some. Yes, disclaimer is very good. I'm definitely not giving anyone advice here. And look, I'm an open book with all this stuff. I'm happy to share it. But yeah, please don't go off and do anything off the back of this conversation without getting some advice first, because certainly
not financial
following
advice.
Not financial advice.
Speak to your broker, speak to your accountant, all that's the good stuff. Yep.
Yeah, hopefully you've got a team of people and they'll be able to help you through it. So with me early days, it was all about trying to get a return on capital, right? So if I can invest, let's say take the example of that property that I bought. I don't even know the numbers, to be honest with you, but let's just say I sunk 50K into buying that $220,000 asset, and that asset went up. It actually did go up $100,000 in the first year because Melbourne went bonkers. Now I've only put down 50K and I've made $100,000 in 12 months. Now, if you're super conservative and you're like, oh, I'm just going to keep my money in a savings account or an offset account, then you have no chance of putting yourself in a position to amplify your returns and your return on capital. So particularly early days, you need to take risks, and you need to put yourself in a position where you get exposure to the market and to assets that will go up in value over time. Because the trick is, no one will ever know exactly what's going to happen in the next 12 months or 24 months. I mean, Melbourne might have stayed flat for 5 years for all I knew, but on average, property goes up, depending on your metric, anywhere between sort of 5 and 8% compound annual growth rate. So you're going to be right over time. It's just a matter of having a position and it building up over time. And sometimes you can get lucky, like that example there.
So do you think about capital return different to equity? So like, for instance, when you buy a property, you're getting an equity. You buy a property, let's say you buy a $500,000 property, you do a $50,000 renovation, and then that makes it 600,000. So we got, $150,000 back. We put $50,000 in, we got $150,000 of equity back. But if you sold that asset, you'd have to have stamps, legal, selling, all of that kind of stuff, which would then be like $100,000 return. But then you run a development with that same it couldn't be 50,000. So it's probably not the best example. But how do you think about the difference between actual capital growth in equity and capital return in a development?
Yeah, it's a good question. I suppose it sort of depends on a multitude of different things, right? So in that example there, you've done a reno, you've made some money, you've generated some equity, which is fantastic. You can't access that equity unless you have borrowing capacity. So that journey of accumulation and of growing your equity over time, absolutely. And I'm sure we'll get into more active strategies as we sort of get further on this chat. But that basis of being able to generate equity, even if you can't access it now, is extremely important. I suppose, for us, we did a combination of different things, and those active strategies. So we will try to renovate every property that we bought, at least cosmetically, to enhance and provide an equity uplift initially. With some properties in the inner Sydney apartments, Darlinghurst and Elizabeth Bay and that area, we would fully furnish apartments to enhance the rental yield. So we would do different things to try and actively provide an uplift. The furnishing thing, that wouldn't have provided much uplift at all, but it was good for depreciation. It was good for increasing yields, and increasing yield, increase income, increase borrowing capacity, and then you can access some of that equity that you've generated through those other uplift renovations.
Yeah, and you get free furniture if
I'm pretty sure it was all disposed of when the tenants moved out. Yeah.
Okay, that's what the tax man knows. Okay, so you I guess to answer the question about the capital, you don't think about it in a different way. It's just the goal here is to put in $50,000 and get more money out of that, as optimize that as well as you can.
Yeah. I mean, at every level, even back then, it was like, okay, how do I get bang for my buck? How do I get the best return on my investment in terms of the asset selection, the money I put into that asset in terms of deposit or a renovation? And now it's the same, even though we're a long way down the track. It's about, okay, well, we're not buying and holding anymore. It's about, okay, if we've got some capital, what's the best way that we can get the biggest return on that capital? And for us these days, it's development projects. But then within that, there's a million different types of developments and things you can do, right? So that's a bit of a rabbit hole to dive down.
Definitely is. So I think we're going to, the really big one that we could talk about, I think we'll leave it sort of to close to the end about the serviceability sort of thing. Because I want to dive into the ways that people can, or the sort of pathways that people can take with their property investing once they build a foundation portfolio. And not to say, look, if you're just starting, this is also very pertinent as well. I think we've missed something though, Joe. We probably need to run to our first sponsor. I just think it's gross so much, but we'll get into that after that.
It's been a great chat. Let's dive into the ad. There's nothing worse than going into a situation unprepared, especially when that situation is purchasing one of the most expensive assets of your life against a trained property expert in the form of a real estate agent. It's a scary thought, but it is a skill that can be taught. Do you want to learn how to become fully prepared when buying a property so you can get out there, buy your dream home or investment property without the fear of actually messing it up? Scott Agate, the founder and expert property negotiator at Hello House, has been helping people buy their properties by stepping in and negotiating with the agents and saving his clients tens of thousands and in some cases hundreds of thousands of dollars. Scott has now decided to share all that he's learned over the past 28 years in real estate so you can go out there and do the exact same thing on how to find a property, analyze that property, negotiate on that property, and transact on it to get the best results. He's created the Get Buyer Ready course, which is a step-by-step guide on how you too can become an expert property negotiator. It's the easy way of how you can avoid all of these agent games and get the best purchase price on that dream home or your investment property. The course is in short bites for busy people with no fluff at all. Just all the information you need to get buyer ready and secure that next property with confidence at the best price. Scott has been kind enough to give our community a massive discount with the link below. Sign up today before you even think about putting an offer on that next property, and it will be one of the best decisions you ever make.
Wow. How good is that cool music? I mean, I just want to jam out to that. Anyway, so we're gonna get into it. There's actually been some really good, interesting comments in the chat about. So Dan, who was that's not the comment I wanted to bring up. This is the one. So somebody says everybody has equity, but nobody can service. So how do we get around that? Like there's a question on everybody's lips. Like, what are the options for people that have built that foundation? They've got millions, maybe hundreds of thousands of dollars equity. What can they do?
It's that is 100% the challenge right now for everybody, and I think you see this play out over time where people can get to a certain amount of properties even outside of this environment. Today it is much more difficult than it's been traditionally. So a lot of people like Mel and I, who I think we had a peak of something like 14 properties. You can't really do that these days. The finance environment's different. The way that we have APRA and the sort of prudential controls around the buffer and that sort of thing, it's not the same environment. And anyone that says you can go out and buy 15 properties, I would question whether that's reality. Certainly, with asset prices going up now, it's different to what it was 20 years ago. You're not going to buy a house in Melbourne for 250, 300K either. So if you're in a position where you've got a mature or the solid foundation. So the solid foundation you refer to, I would assume is you've gone out, you've started your accumulation, you've purchased 1, 2, 3 properties maybe, and you're completely tapped out of borrowing capacity, which is where pretty much everybody is at the moment. I suppose not to discount this right, in that position, it is a good position to be in. You can probably, depending on your age, do nothing, ride the accumulation of compound growth, and have the market double and maybe double again by the time you hit retirement, and everything's going to be okay. You're in a good position. You're in a better position than most people, and a lot of people don't get to that point where I have a lot of clients that I tell, like, just, you should consider, I should tell you what to do, but you should consider buying an investment property. Or the only vehicle a lot of people have is their owner-occupier home, and they're not putting themselves in a great position for retirement unless they go and take that next step and at least buy one investment property. So to have a portfolio where you're tapped out of 2 or 3, I think is always a good position to be in. But to get more aggressive, that requires action. So there are more aggressive finance strategies that you can take, but again, they have limitations. So making sure that you've got the right finance structure to be able to maximize your borrowing capacity is pretty fundamental stuff, and working with a good broker, they'll be able to do that for you. Taking it further, and this is an area where a lot of people are exploring right now, because we've had some sort of change in the non-bank world where we've got some lenders that are using buffers as low as 1%. for new lending, and they'll look at existing lending based on actual
I'm just going to
repayments,
pause
not
that
on.
a little bit, Richard. I want to know, like, tell us about this. Like, a lot of people, like you, I, and Joe all know about this, but I want to know, tell us about this buffer rate. What does that mean? Like 1%. Like, what is it comparable to? Like, for the person just starting their journey, 1 or 2 properties, what does that mean, and how does that help them? Let's talk to that.
Yeah, cool. So APRA basically tell the banks what to do in terms of managing risk, and so the guidance at the moment is that all of the regulated banks need to provide servicing for debt at 3% above what the actual rate is. So, an interest-only rate of 6.5%, you need to show you can repay that at 9.5%, which is crazy, right? Doesn't make any sense.
Because when interest rates were at 1%, they were assessing them at 4%, right? And now we've grown 13 raises, and we're now throwing a 3% is quite large. Substantial.
Yeah, correct. Yeah, they did have a smaller buffer. I think it was October 2021. They went from 2.5% to 3%, which was the right thing to do at the time because they could obviously see that rates were going to go up. And if anything, it's actually gone up further than perhaps they thought it would. But that's one of the other things that can change at some point in time, and it's completely external. So if APRA revise their buffer and reduce that down from 3% to 2.5%, then we might see another sort of 5 or 6% borrowing capacity come out of that. But that aside, with non-banks, another term for them is shadow banks. So they sit in the sidelines.
Scary.
They don't comply. Yeah, shadow. They sound terrifying, right? They sit in the sidelines. They don't comply with APRA's buffer, right? So you've got a bunch of different lenders in that world. That can range from anything from that sort of 1% buffer and then taking actuals on repayments to having a 2% buffer across the board. So what then happens is instead of having to show that you need to repay that debt at 3% above, you only need to show that you can service it at 1% above. And so quite often what then happens as a result is that you have a substantial amount more that you can borrow with those banks. The shadow, it can be a lot, and particularly when you combine that with the fact that they will take actual repayments on your existing debt. That's the big game changer, because if you've got a investment portfolio, and there's a bit of a strategy you can take. By the way, this is more advanced, and you really need to talk to your broker or your lender around the pros, the cons, and the risks, and the sort of long-term plan around this structure, because it can be a space where you can get stuck, and I've seen plenty of people get stuck in that web where you don't have a plan B or an exit plan out of this space. It's really, I would say, it's a temporary measure until you can build your income or your serviceability up to where it needs to be to maintain with banks for the long term. But essentially what you can do is restructure your existing debt, make sure it's all interest-only lending. Then the non-bank will use interest-only lending and repayments as the existing debt, and then you put your 1% on your new debt. And that can really explode your borrowing capacity using those non-banks, and obviously get you another 1 or 2 properties.
How much have you seen that effect? Like, how much of that change have you actually seen in real life? Like, give us an example of, I don't know, 600, 800, like a $900,000 property, and then it went to 3 million. Like, what are we talking?
I haven't had any in that space, and I think that's like usually over the cap for what these guys are willing to look at. But I'll give you an example of one we had the other day. Somebody was completely tapped out of using normal lenders. And so we took it to one of these non-bank lenders, and they can put together a $650,000 purchase at 80%. Just by using that lender and touching nothing in terms of their existing lending. And in that case there, he's looking at it tactically. He wants one more property, and then his exit plan out of that is he's either going to sell something else down, or he's going to renovate and flip that one in the next couple of years. So he's thought through what that strategy looks like for him. So it's not like I'm going to buy this property, I'm just going to hold it forever. because the shadow of the shadow banks is that the interest rates are higher than normal banks. And obviously you put yourself in a vulnerable position where if you can't refinance out of that bank, you're kind of you're over the barrel. So anything could happen and you can't do anything about it.
Yeah, and the other thing as well to keep in mind, and you touched on the risk, not the risk, but the cost of finance being a little bit higher at the second and third tier, mostly third tier. The other thing that I've sort of did find is that the LVRs are typically they get a little uncomfortable anything above 80%. So anything in lenders, mortgage, insurance territory. So have you sort of found that as well? Once they sort of get to 85%, they start charging risk fees and all sorts of things, which the rate can really blow out quite quickly. Is that what you've found as well?
Correct. And they've got loadings and everything. Once you get to a certain amount of properties, depending on who it is, they'll add, 0.5, 0.75, depending on the lender. So it can become a pretty ugly space pretty quickly. But a lot of the time, the means can justify the end.
So how much of a rate rise is the difference? Like, what's the kind of difference that you've seen? Like, it's a 6.5% with a CBA, let's just say. Are we talking like an extra percentage point? So like 7.5%?
Yeah. Usually it's around about a 1%, 1% sort of spread, maybe a little bit more, maybe up to 1.5%. But typically it tends to be around that band.
Depends on the LVR, yeah.
It does,
okay,
yeah.
well, let's run through a scenario then. We've just purchased this property for $600,000. It's got a 20% loan on it. We're getting $520 a week rent, which is a 4.2% yield. If you've got a 6.5% interest-only loan with a CBA or normal lender that's giving you a 6.5%, that's negative $15,323. So if you then go to one of these shadow lenders, which the question then is, do I pay the extra money? Do I pay the extra 1.5%? And am I going to get a better return by investing that capital into that property? So then what happens is that's $15,323 negative. So when you go to this new one, it's $22,000 negative. So that's a difference of $7,200 annually. So the question then is buying this property going to give me an additional $7,200 more than, well, actually it's not, it's $22,000, but benefit of going by CBA. And those are the mathematic questions that you've got to kind of weigh up yourself, right? So it's not actually as much. Like, I thought I was going to do this calculation and get blown out of the water, but it's, $7,000 is a lot of money. Don't get me wrong, but it's annualize that.
If you've got it, if let's just say that property grows 5%, which is not unreasonable that it'll grow 5%, even conservative, 600K, that's 30K. So and yes, the other factor is, yes, you may need to put a bit out from your back pocket if it's not sort of renting for $650 a week. $650 is probably about where it would need to be to roughly be sort of breaking even, depending on depreciation, all that sort of stuff.
Yeah, see, and look, here's the variable difference. Not variable. Here's the difference. Our first Mac loan for our fifth property is 7%, 7.03% versus our 6.75 with CBA.
I'd chat to CBA at 6.75. Go on,
jump on the phone with CBA. I got a phone call from CBA actually. So I think they're actually keen to reduce rates. They're like, "Hey, you happy with everything? Is everything going?" I'm like, "Yeah, I'd love you to reduce my rate." They're like, "Well, actually, I might be able to do something." And I'm like, "Great, give me a call back." They never called me back. But but anyway, one of the things that we were talking about offline was that I thought is interesting is utilizing borrowing capacity as an asset within itself, as its own thing. So the way we like to talk about it is you've got two scales. We've got cash and equity on one hand, and then we're balancing that with our borrowing ability and our service ability and treating them as, can you talk to that a little bit more?
Yeah, definitely. It's I'm very much of the belief that borrowing capacity is the same as capital. It's a finite resource. So gone are the days of unlimited serviceability. So you need to allocate your borrowing capacity prudently in the same way as you would be allocating your capital. So thanks, Danny. I can always rely on you for some supportive commentary. So you need to make sure that And this is where you come to that position of being, in a sort of solid foundation, if you like, or a mature portfolio. One of the tactics that I think is a good exercise to do is to put the mirror up on the portfolio and go, okay, is this portfolio really, optimal? Or are there some dogs sitting in here? Because, like my example of that Melbourne apartment, I've still got it right now. Relative performance, I'm pretty happy with that one. But we've sold down a couple over the last 2 financial years, which were dogs. One of them had a 3.3% compound annual growth rate, which is severely underperforming when you look at a lot of the portfolios got 7, 8, or 9% compound annual growth, and the other one was quite similar. So we're like, okay, well, what we can do is we can sell down. We're in a fairly unique position where we can control what our income is, by company structures and whatever else. So we can wear that CGT tax efficiently, and also the way that we bought these properties, individually and whatever else is sort of by design to minimise future CGT and that sort of thing. So we were able to sell down a couple of properties, pull that capital out. Now we've got that capital that we can deploy in a way that we can get a better return on capital.
Can we just talk to how did you calculate? Did you just literally look at what you bought it for versus, like, how did you calculate that compound annual growth? I think that's an interesting question.
Compound annual growth rate. So if you Google CAGR, you'll find like Excel sheets and stuff. You can just be careful what you download on the internet, I suppose. That's what you say when you're in your 40s. You feel like you're everyone's dad. Just have a look, and you can find a formula for compound annual growth rate online. And basically, it takes into account the amount of periods you've got. So, if it's over a 15-year period, then on average, that asset has grown at 3.3% per year for 15 years. So the only thing is,
what we can do, I'm going to share my screen real quickly, is we have the property property calculator here that allows you to enter in when you bought the property and when it last sold. So you can see here, as an example, we've got a $600,000 property, and it sold in, well, actually, let's do your property. 220,000, 1, 2, 3, and you bought it in 2006.
Yep.
Let's just say June 2006. That has been 17 years, 7.84 years that have passed, and an annual compound rate of 5.8%.
Perfect.
So what I love is, okay, sorry, I'm teasing this. If anyone wants access to this, jump in the comments and we'll give it to you. This is the deal crunch calculator that we have on the thing. That's really helpful. It really helped me because one of the things that stood out to me is Perth market has grown 30-odd%, 25%. Brisbane's
in the last
taken
10
off.
Minutes, Joe. What do you mean? 30% in the last 10 minutes, hasn't it?
Like ridiculous numbers. And you've been able to build an amazingly substantial portfolio, and you were just like, 6-7%, and you've been able to do it. Like, I see so many people getting so caught up, like, oh no, I'm going to wait for the boom, wait for the bust, wait for the thing. Like, no, just take the action, because every time you wait and things go up, you're losing that capital, and then you get too scared to even jump in, and then it's just, okay, well, it's the time. It's not timing. The market is very, very important. Don't get me wrong. You're selective of the market that you're choosing, but it's the time that goes through. But what you will see, I bet, Rich, if we had this conversation when you 5 years in, you would have seen one doing an amazing performance that's like 15%, and then another one 3 years later, that one did a 15%, because that's how the cycles of properties go.
Correct.
So
exactly.
So sorry that I didn't really ask a question or anything from you. But the question I do have is, how, I know I already asked this, but how do you, I don't know, I like to visualize things. How do you kind of visualize borrowing ability? Do you just count it as cash? You're like, hey, I have $1 million of borrowing capacity with the first lenders. So I'm going to max that out with my first tier lenders. And then the third, fourth, fifth, going to start, I don't know. How do you, I don't know. Oh,
Yeah,
shit question.
yeah, good. No, I get where you're coming from. So there's, I guess, there's kind of almost best practice around constructing a portfolio. This might just be my sort of personal view and old school maybe, but based on the way that Mel and I did it, we think it was quite a reasonable way to do it. And so we would each individually, and look, we kind of started this process organically, when she started on her own, and then I sort of started my own thing. So we would buy them individually, and we would use normal bank lenders. Eventually, diversify between states to minimize your exposure from a land tax perspective. So you don't have overexposure in one state and then get a big whack on land tax. And then, eventually run out of borrowing capacity individually, start borrowing together with a slightly better serviceability with, a couple, with a shared household. And then from there, you'll run out of borrowing capacity completely. And then you can start looking at using, those sort of second and third tier lenders to extend that portfolio. Keeping in mind for us, we didn't personally ever get to that point. And the reason for that was we did our accumulation phase pre-APRA. So pre-2016, 2017, when it all changed. And so it's a lot harder to do that now. And that's why I say anyone that sort of tells you can go and do that these days, I don't necessarily believe that to be true, not to a certain size and scale that we were able to do it. But that left us with a challenge once APRA came in, and we went, oh, geez, we can't just ride these interest-only loans forever, and everything's moving over onto P&I. So it's a different challenge, but we were done with the accumulation phase at that point. We were very happy with the asset position that we had, and we basically hit that number where we went, okay, we're actually in a position now where we can turn everything off and do nothing, and we've reached financial freedom to a point.
Can I ask how you sort of determined what that number was? Like, did you sit down and say, "Here's what we're spending"? Like, how did you determine that number?
Yeah, I guess I'm a bit of a data nerd. So, so what are your hobbies? Microsoft Excel is one of those hobbies I've got. So
you do VBA? How about macros? With macros and VBA? What sort of?
Back in the corporate world, I was ready to enter the World Excel Championships, but I've had to hang the boots up because I don't get to do that stuff these days. So no, I'm taking the extracting the, you know what I mean. I'm proficient with Excel, and I have an Excel sheet that I've been tracking for the last 15 years. And that's sort of my version. Mel's not as good with that sort of structured target setting and that sort of thing. She's more I guess entrepreneurial than I am, so she's more about just executing and finding opportunities and making things happen, which is fantastic. I'm more in the back room crunching the numbers, right? Which is why finance is a much better thing for me to be doing than anything else.
So can we talk to? I know I'm sort of pulling you different paths, but I sort of see these comments, and I think they're worthwhile to bring up. Steph has asked, so all your investors paying themselves off. Would you describe that's probably happened over time? Is that the way it looks at the moment in your portfolios?
Yeah, we have a very low level of debt across that portfolio, and the debt structure that we've got now is we've actually got everything set up as interest only, and what we will do is deploy the capital, and still every property has a loan against it, but they're not massive loans these days, because there was a little bit of P&I sort of eating into that when we couldn't service once APRA came along. But we essentially use our offsets as like a giant line of credit. So we'll deploy the funds out, when we need to do a development project, and then once we're done, those funds can come back and sit in against that portfolio. And even with the funds allocated on the investment portfolio, because there's been so long, we've had so much time, the rents have gone up so much since they've been initially purchased, and those debt levels that we have on them throughout the years, everything is positively geared. So it's not really like back in the day it was enough. And, this is where sometimes you need to think about, how things are going to unfold in life, because, my original vision was, I was going to retire at 30 with a Holden SS Commodore in the garage of my house in Hornsby Heights and my two kids. And, things have moved now. We live in Bellevue Hill, got a couple of supercars, two kids, and, all that sort of private school stuff. So the consumption is a little bit higher than that vision of retiring at 30. And then you sort of push your targets out. And to answer that original question, I essentially had a number, a net wealth number, and we hit that number. And that was the decision point to go, okay, well, we can sort of hang the boots up now. We will just go in and out of property development. And I'll do mortgage broking. It's quite funny to say this. I'll do mortgage broking 3 days a week and just live off the sort of work-life balance that delivers. And I've failed to do that, but again, I love what I do, so I wouldn't change anything. But we sort of had a number, hit the number, and that was a deciding point to pull the plug. But then after that, a lot changed. So we're in a different position now.
And how do you feel about the most recent capital growth booms across all kind of markets? Like, has this just brought forward everything of like, oh my gosh, this is incredible, or it's just like, no, this is just a cycle. This is what I expected, as it is.
Yeah, it's a good question. I mean, to be honest, I didn't see the boom coming. I don't think a lot of people did. But when COVID hit, we went really hard, and we got aggressive, and we bought a couple of really good sites in terms of development. And one of them is the owner occupier that we live in. And that worked out really well for us. But then, of course, you look at the portfolio performance over that time, you go, oh, geez, like, we had a couple in Queensland there, those couple that we sold off, that we were wondering if they were ever going to grow.
And then they did.
Then they did in a big way. And so we offloaded them, probably when the market had as much hysteria as I've ever seen in that market. So, in the end, we did well out of it because of that little boom. But I think that the problem with property investment for the long term is you get that sort of shape that it never goes up, exactly, every single year predictably. And so you really hold out for those periods where they go, where things go crazy, because you look at the data and it's all cyclical, and you'll see, 2020, 21, 22 was a crazy time. And there's a lot of different crazy times throughout history that we've had like that. The Melbourne example of 2006, 2007 was another one. And so holding property for those booms is really the name of the game when it comes to passive investing in property, in my opinion.
Yeah, and that's such a great point, because you can focus on growth and get too aggressive and be like, no, it has to be an $800,000 property that's giving me $500 return because I believe it to be the absolute best area. Like, the way I like to think about it is the ultimate goal is to get as much growth as possible for how much negative cash flow your household budget can afford. So, for instance, I'm saving, $2,000. I'm saving $2,000 a month, and that $2,000 is for my property investing, right? So, if I'm going to buy a property that's $12,000 negative, that means I can afford to hold two of those things, right? That's it. I can only buy two properties because it's 12,000 and 12,000. However, what happens over time is your property grows and expands and the rents raise. You start to pay down some debt. You get some money in your offset and you're like, great, I can now go for my next one utilizing this equity. And I've still got some cash to be able to fund it. So it's not a get rich quick scheme. It's definitely a get rich slow type of approach. Which is what I love about this story. You're just saying 7, 8, like what annualized over the whole time, like what is the portfolio growth if you were to put it to, I don't know, that might be a bit of a hard number, but.
I'm sure he probably knows it. He probably has it somewhere.
He's got it on the tip. Look at you, see it there hanging from the tip of his tongue.
Yeah, no, I wish I was across my numbers that well, but it's kind of like, it's an irrelevant number for me. It's more about, what are we doing next? But I know, look, when we shifted from passive to active, that's when the game changed for us.
Right.
But we could never do that unless we had the seat at the table that owning those passive properties gave us. And those passive properties wouldn't have performed the way that they did unless we took more of an active approach with those passive properties as well.
And I think that'd be a good place to go to sort of next up. We'll sort of go to, well, okay, great. I've got this foundation property. And I've sort of started to tap out the tier 2 and tier 3 lenders, the sort of the non-banks. I think then there's a couple of other sort of levers or opportunities that you can pull. I think that'd be good to sort of round out the conversation. So what do you reckon, Joe? Throw to our sponsor and then go there into a couple other sort of little tricks Richard has up his sleeve.
The amazing thing with commercial property investing is that in most cases, it's cash flow positive from day one, which means that you can drive those profits towards paying down the debt. There are instances with commercial property investing where you can actually have the property pay itself off over 10 years, which is absolutely crazy. With commercial property, you get massive net yield, so you can expect anywhere between 6 to 10%. And as we've seen in the current boom, these properties not only provide large cash flow, they do certainly grow wildly in value too. Now, with big rewards comes some risk, and this is why you should de-risk your investment as much as possible. And the way you do that is with expert due diligence. And this is why we highly recommend people hire professionals to help you along in your investing journey. Steve Polisi of Polisi Property is one such expert. Being a chartered mechanical and structural engineer in a past life, Steve draws on his analytical and mathematical skills to do that expert due diligence for you. With 6 years experience in the space, Steve has over 1,200 property transactions under his belt. He's the guy you want in your corner, crunching the numbers and finding the best properties in the best locations, along with ensuring that you avoid the mistakes. Steve has actually even written the book on commercial property investing in Australia, and not only is it a bestseller, I believe it to be the most comprehensive in commercial property investing on the market today. He's been generous enough to give us a massive discount for our audience of 50%. So use the code OZPROP, click the link below, get a copy today, and start learning and getting on your commercial property investing journey.
Actually, that's a good question. That's a good question for you, Rich. What are your thoughts? Because it sounds like you're building this portfolio, you built your foundation, you then got your solid foundation of what you want, and now it's going into development deals to grab that cash and equity and then pumping it to do developments, turn 1 into 5, and then use that capital, then pay down more debt, use that capital to pay down more debt. Has commercial come into this equation? Is it coming into the equation? How do you think about that?
Yeah, so I think for us, I mean, that was a great segue, by the way. We've got multiple different streams, I suppose, around what we're trying to set up as we get toward, I suppose, retirement. And we haven't got a fixed number on when that's going to be because we're having too much fun doing what we're doing right now. But those streams involve, the businesses that we've got, as well as the passive property that we've got. And then there is a missing piece around what else we need to invest in. And I think, commercial is definitely one of them. That just so happens to be the sort of the next one that I would talk to around typically what you'll find if you tap out of borrowing capacity in residential. A lot of people will go into self-managed super fund. I think that's a good place to get one additional property purchase. It does come at the expense of your exposure in, stocks, I suppose, which is an issue potentially. But then commercial is that piece that people can step into when they've run out of servicing. And one of my clients has recently teed up with Steve, and it'd be really good to see that process come to life. Yeah. So I think he's pretty keen. He jumped on the phone from Brazil with Steve. So look forward to seeing that one come together. But that's that space there. Once you've got the capital to invest into commercial, you can unlock different levels of yields. And when you talk about 6% to 10% yields, talking net yields here, the tenant's paying all the outgoings, and you have nothing to do with that until you sort of get to lease renewal, and that's when it becomes a bit more of an elevated conversation. So if you buy the right commercial property in the right location, then that can be very lucrative.
Interesting. Okay, but that's a very far away kind of question. I mean, that's a further away question for you, which is super interesting. It's interesting that is so far away from you, for you.
Yeah. So for us, it's I think I look at that as a passive stream, and I don't need passive income.
Don't need passive.
For me, it's about return on capital now, and you can get some great returns in commercial, right? But that's nothing compared to the return on capital that you can make on a good development project. So,
okay. What do you mean?
Just in terms of, if you allocate out, if I'm looking at a 1 to 3 year time horizon, and I can put, a couple of mil into a development deal, I can make 50% in that period. Whereas if I go and put that capital into a commercial property, the return will be good, but over that 3 year time horizon, I'm not going to get the same sort of return as I am on property development. It's going to be a lot lower risk. Property development's a lot higher risk, but that higher risk comes with higher returns if you can get it right.
Easy as that. Just look at the spreadsheet. The spreadsheet tells you you're going to make. I love it. That's so simple.
I was going to say the problem with the spreadsheet.
Go on, Jeff. What's the problem with the spreadsheet?
Is that it doesn't tell? Because I actually listened to that podcast. I think that Mel was on with Tyrone about it was either one of the others, where where you had that challenge with getting that development approved, or there was some sort of issue where the sort of city market I think it was the 2018, 2019 sort of dip, and that's where you're starting to bring your development to market, I think. So that's the challenge or the risk that you can sort of face with property development. I think you then just sort of decided to hold it for a bit longer. I think that was the outcome of that one.
Well, yeah, this is it, right? And it might sound all good to go and do a development project and you can see some numbers in a spreadsheet, but A, you actually need to go and do it. There's a lot of work involved with that. B, you need the right network of people, to be able to help you through that, and the network of, the knowledge base to be able to navigate and solve problems, which happen every single day on the development side. So it's a very difficult thing. And then on top of all that, you're at the complete mercy of the market. So that project we had that Mel spoke about, that was in Dulwich Hill. I think I was looking at the profitability going, oh, geez, I'm going to buy a McLaren after this. Is going to be fantastic. And then overnight, 60 minutes overnight, Bricks and Slaughter was the article. And
I remember that one.
Yeah, that Martin North, I think that was the first time he got oxygen. And that took the wind out of the sails big time. And we didn't make any money. I think it was a loss in the end. I tried to block it out of my mind. But, we take learnings out of that, right? We had another one. The very first development project we had went completely off track, and it took 2 years to get it approved through council. We had no idea what we were doing. We lost at least $250,000 on that. But these things happen, and I think it almost killed us, right? And for us at the time, it was, that would have been 2010, I think. We were in a reasonable position at that point in time, but 250K was huge. Like, that would have been more than 10% of our net worth. We just lost it on rolling the dice on this development project without even knowing what we're doing. And but through that process, we built the skill set. We built, the understanding, the knowledge base. We met a lot of different people, and people that are still involved in our process when it comes to development now. And I think, you need to find ways to learn from other people before you put your hand under the hot water. Because if you do it the way that we do it, I would say most people probably would just give up and not try and do it again. But we consolidated from where we were, and then we tackled smaller projects. So just, buy and own rock in the inner west and do a DA, which is really simple and straightforward, and then do an owner builder, or manage the trades and build that network a little bit more, and then scale up further and further, and sort of take that gradual step up rather than sort of overreach and end up getting whacked.
Yeah, and so it's surprising you didn't pay like a developer to help you run the development. Like, what are your thoughts on doing that?
I would I would do things differently. Obviously, another point there of learning, right? And I think you know whether I could have found a developer to do a JV on. Hey, look, I've got this site. You or a builder, I've got this site. Do you want to help me get it DA approved and build it?
Yeah.
We'll go halves on it. Whatever it is, we've since done JV projects with other people and different skill sets and that sort of thing. So I think there's
Mhm.
really great territory there that you can explore with people if they've got the skill set or they've got a gap that's missing in your armory, and you guys can work together on it. But yeah, you really need to know who you're working with. But
Yeah.
there's definitely opportunities in that space.
So what were the
I think the
key?
thing I'd
What were the
caution.
key?
Sorry.
Go on, Jeff. Go
The
on. Give us
thing
a
I would
caution.
caution with is you want to make sure, because if you go into whether it's dealing with a buyer's agent, dealing with an accountant, dealing with a developer, you want to understand, you want to have enough knowledge to be dangerous. So if you don't have that, you can run the risk of being somewhat taken for a lens. And even if you do have that little enough knowledge to be dangerous, it can still be sort of detrimental to yourself. So just I like to dip my toe in the hot water before I sort of dive into that, or put my hand on the hot stove. What were you going to say, Joe? What's going on?
Well, yeah, I guess like I don't want to lose $500,000, $250,000. So, what were the key learnings that you took from those experiences? What would you change?
Yeah, well, I just wouldn't have done the project at all
Right.
because it wasn't the right project, and
Yeah.
we didn't know anything, right? We just went, hey, look, we can build 4 townhouses on this block that's on realestate.com, and we just went and bought it. We're
Yeah.
probably overconfident because we'd renovated a few apartments, right? So we really didn't have the skill set, the knowledge to take that on, and we didn't do enough research. We didn't seek advice off enough people to understand, how difficult it's going to be. What are the pain points? What do we need? What do we know that we need to address, and what don't we know that we need to address? There's just so much in that whole process, and development is almost a completely different game to residential property investment, right? So it's like me talking about scaling and building a business. It's almost a completely separate conversation.
Yeah. And also, is this something that, like, because you've built a portfolio and then you've transitioned to, because I always see people that are like, hey, I want to get into developing, and I'm like, no, chill out. Just buy your first damn property first. Don't stress about developing. That is a future you problem when you've got 2, 3, 4, 5, 6 years of experience and you have the time and comfortability of being able to do that. And you don't need the capital right now. You need right now the struggle that you've got is you've got enough borrowing capacity, you've got enough cash and equity to do it. You don't need development in your portfolio. Guess that's not really a question, but I want to hit to some of the questions. There's some really solid questions in the group, and if anyone has any, throw them in now and we'll get to them. But my question actually takes back right to the beginning, where you mentioned that the lending environment with which you were purchasing in allowed you to buy, let's just say you've got 10 properties. I don't care what the number is now. I know it's awesome and it's doing well, which is good. But if you sold down now, you wouldn't be able to kind of bring the portfolio back up to that level from a borrowing and serviceability standpoint. Like, how do you think about that when you're like selling assets? Is that a consideration? How does that be factored in?
Yeah, so I think the thing, like, everyone will hit barriers at some point of their journey, right? And so for us now, it's, how do we put ourselves in a position where we can generate enough income to service more debt? That's a different challenge that we had from, the pre-APRA days, because pre-APRA, it was pretty loose in terms of borrowing capacity and that sort of thing. So I think where we are now, it's sort of, we could sell down everything and then start again. We would still have, because we've invested quite a bit into the businesses in terms of, infrastructure, staff, process. My business is very much reliant on me. But my wife's business is a real estate business. We bought a rent roll last year. We're looking to expand that out more. And that's a good asset that you can get a good return on investment on as well commercially. So, some of that sort of investment there can provide you're essentially looking at a 20% gross return on buying a rent roll, provided you've got the infrastructure to support it. So that will help you, with your borrowing capacity and that sort of thing. So we've got a plan there around borrowing money and sort of trying to scale up a little bit further. So I guess
that's unreal. So even purchasing a rent roll is a 20% return after paying the ridiculous, 3 to 4%.
4 times revenue.
Sorry, 4 times revenue rather than not percent. Unreal.
Yeah.
Wow.
Yeah. Provided you've got the infrastructure, right? In that instance there, it worked out perfectly from a staff and resource perspective. Very little in terms of overheads that, create an incremental overhead cost. So, you wouldn't be able to buy that off the street and start that business because you need to resource it with a couple of staff. Yeah, exactly.
Yeah.
Plus,
and probably sounds like you might be able to build the portfolio again.
Yeah, I think.
Well, for us, you could.
Yeah, and that's probably another point that I think a lot of people kind of, they get stuck along the way with servicing, right? And this is all about the journey, and being successful over time is all around, you've got a problem, you need to find a solution to it. And so ultimately the solution to servicing is more income. And I hear the feedback a lot of the time, and back in the day, pre-APRA, it was a very different environment. But my pure focus from a corporate career perspective was, I'm going to push myself as hard and as fast as I can to earn as much money as I can, so then I can service more debt. And I think people. I see. I'm not calling anyone out specifically. So I just see some people in general might not push themselves as hard. And I don't think everyone should push themselves that hard necessarily. But for some people that have that drive to really go after, that borrowing capacity and really expand that portfolio, if you can have a think about what that looks like for you and how to get there, then you can make it happen. I've seen, obviously see a lot of different incomes, but if you can find yourself a sales role which has an unconstrained upside, there's plenty of industries like real estate that can enable you to do that. Then that can be the fuel that can provide you the borrowing capacity to build that portfolio to the level and ambition that you want.
Yeah, make it happen.
Well, I think it doesn't even have to be like sales is probably the easiest and the low hanging fruits. As long as you're
easiest.
I'm not saying it's low hanging. Of course, it's not, Joe. Mate, look, I've worked in sort of soft sales, so I sort of know that. Yeah, like it's not. But there are. If you're working in your sort of bank role where you're a consultant and all that, figure out a way that your current employer, you can add value, and you're selling to that employer what value you bring to that job that you're doing on a 9 to 5, where you're tapping the keys and moving the paper around the desk, or if you're digging trenches, like what value can you dig trenches fast? Like what is that thing? What is the X factor you can bring? And then sort of go to your boss and say, in 6 months' time or 3 months' time, I feel I'm adding this much value. Let's talk about what income we can increase on the business. And maybe that's tough because unemployment is going up. And if they don't have the capacity, then who else is willing or can afford to pay you that extra money? If that's what it needs to take.
The other thing is, if you can find a profitable side hustle, and I mean, we ended up doing that. I mean, my plan to exit corporate was, let's use the development income to support the income that I used to make in the corporate world, and then we can sustain the borrowing. And so we did that. So we had 2 years of tax returns with this development structure, which effectively replaced my income. The problem was that when you have a bad year in development, you make zero. So all of a sudden, the wheels stopped when we didn't make any money that year, and then we were completely stuck in terms of finance piece, and then we can't borrow to do the next development. So there are plenty of different side hustles out there if people can work it out. Obviously, a lot of people are smarter than I am, but if you can find something that's as passive as possible and as scalable as possible, so it's not relying on you trading your time for money, like it is in a PAYG role, then that could be something that you add to your sort of borrowing capacity toolkit after you've got 18 months ABN and hopefully some decent trading in that.
Yeah, yeah. My little side hustle was I bought a van and put it on a platform called Car Next Door. It's now bought by Uber. And I bought one van, and then over 3 months, it got enough income to buy another van. And then I bought, sorry, 6 months, and then over 3 months, the two of them did well. I bought another van, and then ended up having 5 vans driving around Sydney, giving me a passive income. And it worked out incredibly well. And then it helped my serviceability, but it took a while. It took 2 years to get the income up to that scratch. And then throughout COVID, I was like, I'm too busy. I've got stuff to do. Through COVID, sold all 5 of them, and bought them for $3,000 and sold them for $10,000 as converted camper vans. So if you're there's crazy stuff, anything that you can think, like go onto TikTok and type business idea and you can do something. Oz Cabbie investors. Rich, what are some of so you look at properties, and I wish everyone looked at properties the same way you do. You just look at it from a return on investment standpoint. What data what metrics do you look at as important when you're looking for, let's just say, your next buy and hold? What would you look at? How would you think about that? Like, what are you kind of looking for to see if it's a good deal?
Yeah. For us, it was always about capital growth. So yield, not as important. Obviously, the better the yield you can get, the better everything is, operating cash flow and, ongoing servicing and that sort of thing. But for us, it was all about capital growth. And, we made plenty of mistakes with what we bought and where we bought along the way, because there's very little resource out there. I think these days you've got access to a lot more information, which is fantastic. I also think that can hold people back because there's too much information and then you end up analysis paralysis. So, I think if you can distill it down to, what your style of investing is and then work out, okay, well, I want to go after capital growth. So therefore I'm going to stick to, blue chip sort of capital cities. I might place a couple of bets on a couple of regional areas. You can sort of put together your plan from there. But for us, it was all about capital growth because that was the thing that was going to turn the dial in terms of net wealth at the end of the day.
And are you thinking short-term capital growth or long-term capital growth? Like, how do you think about, for us to buy the next one, I need a 12% growth rate, or how do you?
Yeah. So we would always try and buy the best possible property at the time in terms of that value versus market. So classic example would have been, I kid you not, we would have attended 100 auctions. The first 100 auctions we went to, we won one. So very rarely would we, I would say, buy at market value. We would always try and buy things that we could see value in relative to the rest of the market, and then do something like a really small cosmetic renovation, even if it's just paint and curtains, and then hopefully get some sort of uplift in value in the short term. But the view was always a long term. So for us, building wealth through property over the long term, that's sort of that's the retirement strategy, and then you can reach that point and then choose when you want to turn the thing off and then effectively enjoy life and financial freedom. But that does take a very long period of time.
That's so good. That's such a great way to think about it. Just again, I'm going to plug this bloody spreadsheet again, because I think it's each point that you talk about, we have inside this spreadsheet we don't ever talk about is what if, let's say we purchase this property, it's starting at 6% interest rate, the annual rent is $27,000, and if it grows at a capital gain of 42 grand a year, you're negative $12,000. However, the capital growth has given you a return, and this is expecting capital growth, right? So it grows 42%, you're negative 12,000. That means your property has grown $29,000. Like, these are the numbers that you're talking about here, Rich, of what people should be thinking about. Of you need to be able to afford this $12,000 after tax, after all of that kind of stuff as well. So that cash needs to be there. But I see so many people saying, I have a 5% yield. That's my walk away. That's like my kind of number. And then, oh, great, there's a 4.9% yielding property here. Yeah, no, can't do that. Well, why? What's the difference between 5 and 4.9? Oh, it's $15. Oh, is $15 going to kill you? No. Okay, great. Then, but obviously you need to set that number. There needs to be that walk away number, but don't get too don't get too upset about these cash flow numbers when the growth is going strong as well. But also, do not put in 12%, 15% growth rates. Put in under, little smaller numbers. Any other kind of numbers that you kind of go for?
Yeah, I think it's that. I mean, that capital growth outlook is the main one for us. Obviously, rental yields as good as you can get. Really, if you can enhance it in some way, that's always helpful. But it'd be really that capital growth outlook that's the most important view for us.
Super interesting. So I've kind of taken all of the question time. So I guess we'll get to some of these.
Let's do audience Q&A. You want to read? Yeah, let's do
exactly.
it. I could keep. There's many. I could probably ask about another 40 questions here, but otherwise we'd have a 5-hour session. So I want to. This is an interesting one that gets quite topical. And somebody said putting my principal place of residence, owner occupier, on interest only will improve serviceability. Well, I mean, not maybe it will, maybe it might not, because depending on which lender because some lenders will buffer it based on they'll factor your So anyway, long story short, it potentially can, yes, but is it wise? The question I've got around this though, Richard, is because a lot of lenders don't like interest only for owner occs because they don't like kicking you out of your own home. They want to see it paid down, so if they do ever have to repossess something, they're sort of you can sell it, decide to sell it yourself without them selling it from underneath you. What are you seeing in the market now for interest only owner occ, and what do you think about it?
Yeah, it's not a very common strategy to go to that extent. Usually people will refinance all their investment properties back to a 30-year term, 5 years interest only, or even 3 or 2 years interest only, and then leave the owner occ on P&I, just because you've got that, you're paying debt down over time. But particularly if you've got a big owner occupier loan, if you switch it over to interest only, then that's going to boost your servicing a whole heap. And then I guess the question is, if you're going to buy the right asset and you've got a tactical plan around why you're going to buy that asset. So take that example of buying the apartment in Melbourne. You bought that apartment just before the market boomed. You made $100,000. Yeah, you're paying a higher interest rate on your occupier because it's interest only. But as per Joe's example, that was only $7,000 extra in interest per year. So the means justifies, the end is justified by the means. So I wouldn't blanket recommend people go out and do that strategy. It needs to be considered with the risks around it, and then you really need to know what your exit plan is. How are you going to get out of that non-bank lender if you go down that path?
Yeah, because it's very hard once I saw when I was broking, I was sort of not doing it for years on years, but you did see those investors that had that sort of 8 to 9 to 15 properties, and they just came to you and they're like, well, what can you do for me? And they're like, well, you're going to have to stay at that lender. Like, you can probably get you a couple $100,000, but it's not going to CBA or ANZ or NAB. You're going to your Peppers, your Liberties, your Bluestones, those kind of people. And there was that lack of sort of strategy around, okay, great, I've gotten this situation, but how do I get out of it? There's not that kind of critical analysis for some, and I think it's vital.
Interesting. What's the next one?
Here we go. How do you actually, is it increasing income? Is that the top? I suppose it's not the question being asked. Did you move it back to the mainstream lender? How long did you take to move it back to the top tier? I mean,
so it depends on the circumstances, right? I mean, obviously you would move it back as quickly as you could, but here's a great example where a non-bank works. I had a client buy a property as an owner-occupier, and we used a non-bank. With a bank, they could service $300K. With a non-bank, they could service, I think it was $700 or $800. Wow. So they bought a much bigger asset with a non-bank with a better serviceability. Now the plan there was that the female applicant, she's out of work, so she went on maternity leave. She's coming back in 12 months' time. So in 12 months' time, they're going to have dual incomes. They'll service with a bank, so they'll just refinance back in 12 months' time. So that's an example of how you can sort of work out what your exit plan is. You need to work through those scenarios with your broker to work out what numbers will work. But, you might have a pay rise or a promotion. You might move to a competitor. It might be a combination of stage 3 tax cuts plus, your own pay increases plus APRA revising the buffer down plus, interest rate cuts. There's a lot of different things. Some you can control and some you can't control that you need to weigh up.
There you go.
Love it.
That's you answer these questions very succinctly and comprehensively. I like the way you answer questions. Your mechanical brain singing away. I think you started this one, Joe. It's a good one, but it's a very kind of depends.
So we now have a solid base of $3.5 million in investment properties. None of this is financial advice, by the way. This has got nothing to do with your situation. It's just a random question, randomly answered. We are thinking of adding more apartments now for higher cash flow plus less land tax. Any thoughts on this strategy? Yeah. What are your thoughts?
Yeah, we hold apartments in our portfolio. I guess apartments get a bit of a bad rap. Obviously, we even saw that live example that was unprompted earlier around my Melbourne apartment, where if I had bought a house, I would have done better. Now, the reality is that if you're in a position, or we've already got a solid, I guess that solid base, then you're finding, okay, well, I've got a problem. How do I solve that problem? There could be a million different things that you can do if you want to avoid the land tax position. If you potentially can invest in different states. Look at the ownership structure. If it's you and your partner, are all them individually owned, or are they owned by both of you? But potentially there's some servicing there you could tap into and still buy a house in another state. But yeah, I'm still a believer in apartments as an investment, but it really needs to be the right apartment in the right location. So, if you're investing in Sydney, in the inner suburbs, it needs to be one that meets a criteria around the right sort of suburb, the right, land size for that block of apartments, a very small block of apartments, no high-rise stuff, combustible cladding, all that sort of stuff.
Yeah.
Right? So,
because
my big fear is
focused on cash flow. They said, should I go for kind of cash flow? Like, do you look at units as a cash flow kind of focus?
Not really, because it depends on the strata costs, and typically you'll get a better gross yield. Maybe this is one to look at commercial if you're after cash floating yield, but typically you'll get a higher gross yield with apartments, but then that strata will eat that gross yield away. So you need to look at the whole picture and the numbers on balance.
What do you think, Jeff? How would you go about answering this question? What are your thoughts?
I'm not a huge apartments scare me a little, because you have to. My big fear is, and yes, you can get maintenance with houses, but my concern is that there could be like $100,000 special levy requirement raised, and then I'm sort of, let's just say there's 6 apartments, so do that. That's approximately sort of $15,000 to $20,000 you'll need to sort of put in, which is fine. But imagine if then there's sort of concrete cans and all these, like, it just concerns me. And I just think, well, what is the purpose? I would have to become an expert in apartment investing. So for me, I need to understand the asset before I sort of pull the trigger on that. So if it was purely for higher cash flow, then just there are sort of markets out there where you can sort of achieve that 7 or 8% cash flow with a house. You have to really look for it, or granny flat even. Granny flat's another, and then you sort of, and yes, you then sort of compromising somewhat on the capital growth. So I would personally, and not everyone do what they got to do, but I would go and utilize that, buy a house with the potential to build a granny flat down the track if you needed to boost and you didn't want to go commercial. That's what I would do. I would probably not do an apartment.
Yeah. If the idea is cash flow, what can you do to optimize your existing portfolio, or any of those properties, one that you could do the granny flat strategy on? Because I don't think that's a great one for capital growth, but it's a great one for cash flow.
Yeah, exactly. And that's kind of how
there's even other asset classes. As much as we
exactly.
don't.
I think that's where this is a limited knowledge question of, I think it's now time for you to start expanding your knowledge around the other types of assets. Just because you think units are a cash flow strategy, that's not the case. There might be less land tax because it's a less land component, but there are probably better areas to invest the capital into. So I would say start.
They're doing pretty well though.
Definitely not undermining the results that they've gotten so far. They're crushing it. But expand your reach now. Like someone said here, like micro apartments. What the hell is that? Can you do that? Can you work to that? Is that something that's going to work for you? Learn about it. See if it is. The answer might be hell no. Rooming, whatever you want to call it.
Micro, yeah.
Cool. Okay. I'm just cautious of your time, Rich. So let's hit to.
I want to hit this one, because this one was a really good question asked by Dan earlier, and he said, "Does individually or combining have any noticeable difference in borrowing capacity?"
Well, Rich was saying that he did that, right? He maxed out his borrowing capacity in his individual. Yeah, can you talk to that?
How much does it sort of impact things, or can it impact?
I wouldn't have a number, but definitely if you've got two borrowers together that are, spousal, then you can get the efficiency there. And typically what it is around the household living expense and the benchmark HEM that's used. So if you're single, and it depends on the lender, because there's a heap of different policies that you can use to navigate this. But I mean, generally speaking, if you're somebody who's partnered, they will take a higher living expense than if you are just single on your own. And therefore, if you can structure it in a way where you've got both of you together, you get the efficiency. So whatever that benchmark is for the individual, it's not two individuals added together, it's one household. And so instead of $2,000 each equals $4,000, it's more like $3,000 for the household. So that's where you get the gain.
Like that. Yeah, okay. It's just literally a number and efficiency game. There's a good comment that's come up here from the group. So we love people participating in here. I'm a strata manager. Agree that the rental yield can be good, but so can with houses. Apartments are subjective. The ones appreciating are generally in sought after locations, older style, Art Deco structurally built well, low strata levies, but need to do your research into any building defects, maintenance plans for the apartment building. So that is
it just feels like a minefield for me, like aiming to sort of get my head around that, and then actually make sure that I'm buying a good asset as well. Like, I'm sure there's people out there that probably do it really well, but I just don't think I'm built for that.
I think my third purchase was going to be a unit. But I went for it. It was $200,000. This was years ago in Kippering, and someone passed away in the house, and they stripped everything. They took the skirting boards, everything, the kitchen, the bathroom, everything was empty, and it was just a blank canvas. It should have been about $300,000. It would have cost me $30,000 to do the reno. So I was like, I'm up money. So I don't really care what the asset is, as long as I can make money out of it and do Richard's strategy as well of pushing the value himself. Rich, you're not waiting for the market to push the value. You're going in there and making the value happen. And then any market growth on top of that is a nice cherry on top. Mate, this has been an unreal session. I didn't know what to expect out of this session, to be honest. We get a lot of mortgage brokers on because you guys are the finance people. You know the numbers. But what I've taken away from this is the way that you look at property, and you're like, I don't care what it is. Like, it's just a number. It is just a number to give me a return on investment for the capital that I invest. And that's my takeaway. I'm going to take that away, mull on that over the next couple of days. And then I might call you up and chat some more if you don't mind. But if like me, I want to learn a little bit more about Rich and about the business that you run, can you give us a bit of a rundown of how that all works?
So I suppose, my business, Freedom Funding, we've got a team of 7 of us. So I've got a couple of brokers that work alongside me. You can get in contact with us if you Google us. We're based in the inner east of Sydney. We've got an office there, but most of the stuff we do is virtual. So if you jump on the website, you can book a call, and I'm more than happy to have a chat and work through the specifics of your situation, or just have a general chat around property or cars.
Tell him what your favorite car is, I suppose, and he might be on a longer conversation with him, perhaps.
Exactly.
It depends on how much time. But I appreciate you coming on, and you sort of said at the start of the year that you wanted to get out and sort of speak to more audiences deliberately to sort of share that knowledge and wisdom, which is very admirable, because it does take a little bit for somebody who may not sort of feel as natural. And I think you are very natural to come on and say hello. So kudos for doing that to you. And appreciate you sort of sharing an hour and a half with our life and probably several hundred people, maybe 1,000 now. So
yeah,
good on
appreciate the opportunity to jump on, gents. It's something it's not natural for me to put myself out there, and you know, I think this year it's a bit of a change to sort of be more vocal and I suppose try and share that knowledge base if I can, and hopefully some people on the call today took some value out of that, and I guess more importantly can take some action and go and build their own journey from here.
Yeah, it doesn't need to be too complex. Unreal session, mate. So much value. Everyone's throwing in the thanks. So let's do it, mate. Let's go buy a property. See you guys later. Have a good one.